Hi, everyone. This is Rob Roy of Elliott Wave Options, and welcome to TradeFinder Live. As you can see from the background, I am still the cabin in the mountains, so glad to have everybody with TradeFinder. And if you're streaming on one of our live stream services, whether it be YouTube or any of the other social media platforms, glad to have you as well. I'm going to have a special comment for you guys here in just a couple minutes. But before we get to that, let's get to the important stuff. First, if you haven't seen one of our videos before, we need to show you this disclosure/disclaimer. It is important. So if you're seeing it for the first time, please read it in detail at your leisure. And a couple things that the powers that be wants to make you aware of is, number one, we are not registered to give individual investment advice in the United States. And number two, because we have a lot of international viewers, any pricing we're talking about is assumed to be in US dollars, unless noted otherwise. Other than that, the way TradeFinder works is we'll go through and talk about the markets, and we've expanded this based on your comments. We talk about the US markets, but we talk about some of the other markets as well. But all of the issues that we show are tradable on the US market. So don't tune out if we're talking about Australia with the XJO, et cetera, because that's an instrument that we can trade on the US market. So if it has a great chart and we want to look at it, then hey, let's pay attention to it. So it is important to look at markets all over the world, and there are good patterns in alternative markets. So just wanted to kind of make you aware of that. We'll talk about any close alerts that we may have done for our current alert subscribers, give you an idea of how that works. Then we'll review any case study considerations from previous trade finders, and there really isn't much left. We pretty much closed everything out last week. A couple to look at, and then we'll look for new case study considerations for this week. And at the end, with whatever time we have left, we'll open it up for a general Q&A. You can ask anything that you want, but normally that comes down to you asking about your favorite stock symbol, and we taking a look at what our technical indicators have to say about your favorite symbol. So that's it. Again, welcome to everybody. Welcome to our subscribers. Welcome to you, those of you that are TradeFinder subscribers, and welcome to those of you that are streaming on YouTube. Before we go any further, before we get into talking about the markets, etc., one thing that I wanted to make you aware of is tomorrow night, we are going to be presenting our new AI-based time strategy. Our current alert subscribers already have access to it, but we're opening it up to the public for the first and only time. And we're opening it up for you that are TradeFinder subscribers. So if you're streaming on YouTube and you're not actually a TradeFinder subscriber, please do so now. Become a TradeFinder subscriber so that you'll get your invitation. Those of you that have already subscribed to TradeFinder should be receiving them. We'll make the presentation tomorrow night, and we're only opening it up to a limited number of public people. And the reason for that, which you'll understand as we go through the presentation, is we don't want too many people trying to place these same trades and skew the exact circumstances that we're looking for. If we do that, then it kind of short circuits the issue. So I know a lot of people will say stuff like that from a marketing standpoint, but we really mean this. We have a targeted number of people that we're going to open this up to, and then that's it. So those of you that are TradeFinder subscribers are going to get the first shot at it from the public standpoint. If you use up all the spots, it's not going to go on YouTube. If you don't, well, then maybe some of the YouTube viewers may get a few shots at it from the general public, but you as TradeFinder subscribers get it first. So if you're on YouTube or if you're on one of the social media platforms and you haven't subscribed to TradeFinder, do it now, because once you see it, I think you're going to be really excited about it. I think it's the future of where trading is going to go. In fact, I want to show you something here that was on CNBC. So give me a second here to change my screen over and show you this. This was on, let me make sure that you're still seeing this. This was on CNBC's mobile platform. Look what number one says on there: how AI is set to evolve in 2022. Well, I think we're on the forefront of that. I think we're on the cutting edge of that. We already have a strategy that's directed by AI. We gave it some parameters and we asked it, okay, can you take this and run with it and make it better? And they did, by adding over 300 more data points to what we presented with them already. And if you haven't heard this before, the guys with the AI background, the programming guys, are traders as well, and they liked it so much they're not giving us the intellectual property. They're keeping it and they're trading it on their own. So we're just going to get the signals from them. We're never even going to get the intellectual property, even though I feel like kind of we had part, to do with it, because we gave them the initial idea and they ran with it. But they control things, I guess, at this point in time. But I thought that was really interesting that showed up on the mobile platform for CNBC. And here we are starting 2022, and we're starting it from that exact same standpoint of what AI can do for us moving into this current year. So with that, we'll go ahead and take a look at the markets. I think everybody is still seeing the screens as they should be. A couple things to note here. Number one, we had moved from the highs down to that area just below the 50-day moving average yesterday, but we closed above the 50-day moving average. Look what happened today. Traded below the 50-day moving average, closed above the 50-day moving average, closing right dead on the 10-day moving average. So the interesting thing about yesterday was we actually had a gap down, and then it recovered and filled the gap on the close. So you don't see the gap on the chart, but if you've been looking at a live chart, intraday chart, you would have seen the gap on the open trading lower and then turning around and coming up and filling that gap. But filling the gap, that was one thing that was good, but that wasn't the most important thing. The most important thing was the fact that it closed back above the 50-day moving average. And then again today, and we're trading right at that 470 level. Now we sent out a note to our subscribers, and we do that on our website, EWOtrader.com. Not only do we send out alerts where we send out entries, any adjustments, and exits, from time to time we'll post commentary, usually at least 3 times a week on what's going on in the markets. And the last thing that I posted to them was that, okay, 470 was broken. Now 470 becomes resistance. And look at that. Where did we close today? The high of the day, 469.85. That's awfully darn close to 470, and we closed at 469.75. So we closed 10 cents below the high of the day, right there at the 470 level. So where 470 was resistance for a while, we broke above it, trying to come down and test it. Is it going to become support? No. Broke back below it. It's still resistance. So 470 is resistance, and 450 is now the support area, and that remains a very strong level of support. Even as bad as things seem for the past couple of trading days, we didn't make it down to 450 on the low. We got kind of close on the low yesterday, trading down 456, but not all the way down to 450. So where do we go from here? Well, Chairman Powell was going through his testimony today because they're doing the confirmation hearings of him having another term as the Fed chairman. And he was a little softer, but not a whole lot. He was still basically saying they're going to do what they need to do to rail in inflation. Same guy that was saying that inflation is transitory and it's not really a big deal. Well, now they're going to do whatever they can to get rid of inflation. So I've termed Chairman Powell as like a fish out of water, flip-flopping back and forth. I think that's the best analogy, and that's what he does. I mean, he changes. For those of you that have been trading a very long time, and was going through emails, and by the way, as an alert subscriber, you can email me directly at any time talking about how long I've been trading options going back to 1996 and the Greenspan years where Greenspan had the Fed speak. There were actually cartoons about him where he would say a whole lot, but nobody knew anything about what he was talking about. It was just the biggest bunch of gibberish ever. Well, now we get to the point where they're so reactionary. They come out and they say something based on the data that day. And then if there's some different data the next day, then they completely flip-flop the other direction. So fish out of water, flip-flopping back and forth. Man, it's just a different Fed these days. And now we've got Chairman Powell for another term. So get used to it. That's what's going to happen from here. The bottom line, I think 2022 is going to be the year of volatility. 2021, not so much. 2022, I think, is going to be a whole different year. I think we're going to get big swings, just exactly like the way we finished the year and started this year. I think that's how we're going to be. Look at these big intraday bars here on what's happened since the beginning of the year. I mean, there's no little bars anywhere. They're all big intraday swings, and I just think that's the new norm. And get used to it. That's where we're going to go from here. So again, to reiterate, as far as the market, we're right at resistance. If we can break back above 470 with a follow-through day, our alert subscribers know the importance, and our educational content at EWOtrader.com is really extensive. We really pride ourselves on the educational content that we put out, but we talk about that in the education as far as you have to have a follow-through or confirmation day, a break of a major moving average, major support level, breaking out of a triangle. One day doesn't mean anything in those regards. You have to have the second day, the follow-through or confirmation day. So just breaking back above 470, breaking back above the 10-day moving average, which I think is really interesting that the 10-day moving average is exactly where 470 is, exactly where resistance is. If we close above that tomorrow, that is meaningless. You have to have the second day. Then it becomes a whole different story. So if we can close above 470 in tomorrow's trade and then follow it up with another close above 470, then you have to say this was nothing more than another one of the glorified tests of the 50-day moving average. Now, if resistance hold and we break back down, we could be looking at a close back down near 450. That's it. That's how the markets work. For those of you that are live streaming, some of you on my last YouTube market update ask about the Qs. We do that periodically, and you can see that the Qs move to the downside. Let's look at TNX first, and then let's come back to the Qs. How about that? Look at the 10-day, or the 10-year interest rates. Finally, a little bit of a back off. And you know how I feel if you've watched any of these recordings before about these vertical moves. What goes vertically up often comes vertically back down. So if we can get to the point where we can start to get a move down, and if you've been watching this Elliott wave chart, it's relabeled, right? Because we were at the wave 5 level. Now we've relabeled to wave 3. It's like, oh man, look where that wave 5 is now. It's at that level that I said the market wouldn't handle too well. I believe this. This is my opinion, nothing more. So that's meaningless, really, because the market doesn't care what I think. But my opinion is that as long as interest rates hang under 2% on the 10-year, we'll be able to digest that. The markets will be okay. So if we pull back a little bit into a wave 4, that's great. That's going to be kind of the all clear for the markets. But if we move up and hit this new wave 5 projection here at 2% on the 10-year, I just think that round number, just the idea of the 10-year being back at 2%, where it hasn't been for quite some time, I just don't think the market will handle that very well. And again, that's nothing more than a personal opinion. But as far as where we are chart-wise, dealing with technicals, which is what we choose to trade on, you can see that we had gotten a little bit overbought, some separation with the 10-day moving average. So today was a step in the right direction with a move back down, and maybe we do it again. You can see that we have some support right here at 17, which is the highs from both October and November on the 10-year. So moving back down to test that, very healthy. Even a move back to the upside a little bit is okay. I just think we need to be careful with what happens if the 10-year does actually get to 2%. Could be a whole different scenario. All right, so let's go back and look at the Qs now with that in mind, because remember, as interest rates go up, tech stocks suffer. And you can see that the Qs are a much worse chart than we have on the SPY. We haven't even made it back to the 10-day moving average yet. And we had a bearish cross there of the 10-day crossing below the 30-day. That's a big market maker level. They like to watch the 1030 cross as far as trending indicators. And you can see that now 390 is the support resistance line for the Qs. So it's resistance now. We got to get back above it. So same thing as 470 on the SPY. We need to get back above it with a follow through a confirmation day on the Qs for it to continue to move up from there. So there's no real leadership there. Let's look at the IWM. Where is the leadership in the market right now? So let's take a look here, and that in it. You can see where we're still fooling around. We tried to break out of it, and then we're back in the same trading range that we were for the entire year of last year, between 210 and 230. So we came back down, tested it, broke back to the upside nicely today, but it doesn't mean anything till we break above 230. So that's no good. Where's the leadership? Here's the leadership. This is something that I think you want to look at least for the first part of the year of 2020, the XLF financials, because of what I showed you on interest rates. As interest rates move to the upside, the financials do better. Why? We've talked about this so many times. For those of you that have listened to these recordings numerous times, financials do better when interest rates go up. Why? Because they borrow in the short term, they lend on the long term. And as interest rates start to grow higher, the spread widens. So that spread between the short term and the long term widens. That's where they make their money. They make their money on that spread. So look at that chart. That's the best looking chart that exists in the market right now that I've seen. So you can see that we've broken above this area here, just under 41. And if we look at the DMI, look at that. The ADX is broken above 20, good separation between the positive and negative directional indicator. The only negative, if you wanted to bring out a negative, is that we had a nice update today and we kind of had a tilt down in the positive directional indicator. That would be one negative that you could come up with. But if you look at the CMF, the money flow, that looks great. And not only does it look great, look how long we've been diverging in the right area from moving to the upside here, from below to the upside. And if, again, we have all of these indicators in educational content on our website in the education area. We talk about each one of our confirming indicators. the CMF is a lot more than just, is it below the zero line or above the zero line? Are the lines red or are they green? There's a lot of talk about divergence and convergence there. And so right now you can see that we close at the high of the day on the XLF. That's a nice big bar on the CMF, moving up on the ADX. Just because the positive directional indicator didn't tick higher, we're still between the two. So still looks pretty good, even though maybe we could have wished for a little bit of a move back to the upside on the positive directional indicator. But there's your key. We broke above this resistance here from going back into the end of October, right there around 41. So as long as we stay above 41, you got to be along the XLF. And if it breaks back below it, whole different story. But for now, that looks pretty good. And then if we were to look at the CCI, you can see that, well, we're in the upper threshold there, have ticked back down a little bit. So there's some room, but perhaps we stay up in this area. But it shows you that there was strength to this move on the way up. So could we expect it to continue? The DMI seems to think so. And with interest rates higher, I think that there's a major rotation going on in the markets, and the XLF is a place that you want to take a look at for 2022. So there you go. That's something that we could look at moving forward. That really wasn't the idea of this. We're looking at markets, but kind of got off on a tangent there on looking at where we can go from here. Let's look at the diamonds. I know we have a lot of people that ask about that week in and week out, and you can see that kind of a different looking chart than the SPY. And if we put the Elliott wave pattern on, nice wave 3, looking at the DMI, you know, that ADX is like, not so interested right now. So the wave 3 looks good. The longer we can stay above 365, the better, but we got to get back above there first. So breaking back above 365 becomes the task at hand for the diamonds. Now, there's one thing that's similar to the SPY is the diamonds tested again the 50-day moving average. So once again, testing that 50-day moving average and closing right on the 10-day moving average. So the Dow and the SPY have not been so much in sync lately, but right now they kind of are, as far as the 10-day moving average. So usually I say this to our subscribers on Thursday night. By the way, if you're become an alert subscriber, every Thursday night we do an event like this, but it's only for our alert subscribers. And we talk the markets again. We talk about our open alerts. We ask questions and answer questions, etc. So we go through that. And it has just seemed like for the last several weeks that on Thursday night, it's like, all right, well, tomorrow's trade becomes important. So it's become a joke with the alert subscribers, like, oh yeah, tomorrow's going to be important. Well, now we have a scenario where on Tuesday night, I'm saying that, hey, tomorrow's trade becomes important because both the SPY and the Dow are both closed dead on the 10-day moving average. So that means that tomorrow's trade really matters. And then you know what happens from there. We break back above these 10-day moving averages. Do we get the follow through our confirmation? So we've looked at the IWM. Let's look at Bitcoin. Bitcoin is really trying not to give up the ghost here. It's come awfully close, but it's trying hard. We talked about this, and man, Elliott wave has been so spot on with Bitcoin. It is almost unfathomable how accurate it's been. But we talked about how if we broke 44,000, 40,000 was probably next, and probably in a very short period of time, we'd see 40,000. So there we go. There was the low. And I know Bitcoin trades 24/7. I totally get that. But we look at end of day charts. So at some point you have to print where's the end of the day. And then you look at that, the low was 39.63. So right at the 40,000 level, and that was on the 10th. And so if we can hold this, but the wave 4, let's talk about this for a second, because this becomes really interesting. Elliott viewed if you got to a wave 4 correction, but Elliott was a big believer in Fibonacci levels. So remember that. But Elliott believed that if that wave 4 got to a 70% corrective level, that you were likely going to see the end of that impulse pattern. The impulse pattern would become disqualified. But when relying with Elliott wave and its congruence with the Fibonacci levels, you needed to get to that 78.6% level. And we're not quite there yet. We're almost there. But if we hit that level, according to Elliott wave and Fibonacci, that means we retrace the entire impulse move. And that's a 32,000 reach on Bitcoin. So Elliott would say, yeah, that's probably going to happen. But in sticking with his rules, because he had opinions and rules as well, if you stay hard fast to the Elliott wave Fibonacci rules, it hasn't quite fully disqualified that wave 4 yet. So there's a chance that potentially that 40,000 level could hold, but we got to get back above 44,000. And that's the key on Bitcoin, is what was support, and it was support for quite a while, is now resistance. So we got to get back above 44,000 with, say it with me, a follow through or confirmation day. This means nothing unless we have the follow through or confirmation day. So we got to get back above the 44,000 level with a second day on Bitcoin, or we may very well be looking at that 32,000 level. I think how the market goes is how these assets are going to go. There's so much controversy and conversation regarding Bitcoin, talking about risk on, risk off, risk assets, getting out of risk assets. And then there's the whole thing of, well, when we're dealing with cryptos, the negativity associated with the energy required to mine for Bitcoin, and that the newer generation is not in favor of that, and looking at other cryptos other than Bitcoin. Is just, the conversation goes on and on and on and on. And so where does it go from here? I don't know how you decipher all that chatter. Look at the charts. Follow the charts, especially when you're dealing with Bitcoin. Follow the Elliott wave, because it's been so, I mean, for a couple of years now, it's been nailing it spot on. So why abandon it? So I think that you look now at the last bastion of support there at 40,000 on that wave 4. If it can hold it and we can get back above 44,000 with a follow through day, it could be no harm, no foul in looking at the wave 5 continue to the upside. That hasn't happened yet. So until it does, you have to look at that 32,000 to the downside as a potential move. So I mentioned the XJO in the intro, talking about Australia, and man, the Aussie market is forming a fantastic triangle. You can see going all the way back here from the set of higher lows, and then just recently where we've had these lower highs. The lower trend line is far better than the upper trend line, and I say that because I like when we draw these trend lines on triangles, the more touches of the trend line, the better. That is really good looking on the lower trend line, which is the higher lows. But as far as the lower highs, it's a little vertical, so it's not as symmetrical as you would like. But you can't argue with the fact that that is a triangle. And then look at this, the triangle is formed in the wave 4. So Elliott himself would say that is likely to break to the upside. Now, this is where we come in for our subscribers and say, all right, we do like Elliott wave. We do profess Elliott wave. However, we approach Elliott wave from a trader's approach. Maybe we don't bend any of the rules or anything, but we talk about how from a trader's standpoint, perhaps you want to give a little bit more leeway. Perhaps you want a little more room for potential move in either direction. And that really comes into triangles, is respecting the fact that when you have a triangle, it can break either way. Elliott may say the odds are it breaks to the upside. Fine. But what harm is there in putting on a triangle or a strangle for the triangle where you cover both directions? Other than, all right, you're limiting your potential profit potential by putting on a strangle, but yet you're increasing your potential of being right by covering both directions. So why not do it? I don't think there's a good argument other than Elliott saying, oh, it's going to go to the upside. Well, maybe it does. If it goes to the upside and you have a strangle on, you still make money. It doesn't mean you're going to lose money from that. It's still profitable. So I think that is really interesting with the XJO. And then look at where the point is. The point is right there, just above this area of major support resistance going back to September, where it came down and it found support there, then broke below it. And we've been going back and forth, and that's almost the exact point of this triangle. So I think we're going to see a pretty decent move out of the XJO here in the not too distant future. I'm not going to be like Elliott and call it to the upside. Hope it does, because I know more people make money when things move to the upside. I prefer trading to the downside because things move faster to the downside. But I'll root for Elliott on this one and hope that it breaks to the upside. But I think that is a real nice trade there on putting on a strangle in the XJO. It's pretty wide. We're coming all the way down here, and look at the support level. I mean, it doesn't get much better than that. Look at that. The bottom end of the triangle is right at a massive point of support. Right there, 7,200. And then we got the upper end of it at resistance. Going back to that previous wave 5. Can you ask for a better scenario in a triangle? They don't set up, they do not set up any better than that. So the top part of the triangle is at major resistance. The bottom part of the triangle is at major support. And we're dead smack in the middle between that range on the point of the triangle. That's as good as it gets. So you know exactly where you're going to go if you break to the upside. You know where you're going to go if you break to the downside. So the setup is as ideal as it gets. So take that for what it is on the XJO. Let's look at the Nifty. Could we get back above 49? We talked about 49, 47, 45. You've heard me talk about numerous times. And look, we did. And then we've gapped back above it. So we came all the way down to 45. We said if we broke 49, we go to 47. If we broke 47, we go to 45. Hit all those. And then we said, okay, well, we're back here at 49. Can we break back above it? We did. And now we're off to the races again. So we're getting to the point now where it wasn't that long ago. Well, it was a couple months ago that it's talking about, you know, the Nifty is the best looking chart in the markets. It may be that again. Pretty interesting that we had this drop to the downside, and look at this zigzag pattern that we had here. You can see how we had a really nice zigzag right there. Look at that. You know, it looks like I stage all this stuff because it's so amazingly accurate, and I don't. That's the first time, no lie, that I put the zigzag on that move on the Nifty. And look at 38% B wave correction. A 38% B wave correction means a 61.8% C wave extension. Look where we closed. Dead on the 61.8% C wave extension. If you've been watching these, and again, welcome to those of you that are watching on YouTube Live or any of the other streaming services, how can you discount that? You can't. The math is there. It's the proof is in the pudding. It's unreal. I mean, it really is. So we hit the C wave extension. That's where we were supposed to end. And we did, and we've done nothing but go straight up since then. Now we're getting a little vertical on that move, so perhaps we need to come down and test 49 again on the Nifty. I don't know that I would be so strong about going long right now after that big move, but no doubt that's been pretty impressive from the lows there at the 61.8% extension. And so now we're back to the DAX, and we've got this the wave 4 correction there at 50%. And until we get it back above that and break to the point where likely even getting above 34, breaking above that level, it's very hard to be too bullish on what's going on in the DAX at this point in time. It developed some support there at 31. So I used it as a bit of a platform to bounce to the upside, but we didn't even make it to the high. I mean, look at this set of lower highs. So if you're looking at from just a purely technical standpoint, not even just Elliott wave, but just flat out lower highs and higher lows. You can see that we have a set of lower highs there on the DAX, and wait for there at 50%. We could be getting ready to head lower on the DAX. We'll have to wait and see. If it breaks above 34, that changes everything, but it's got to get above 34 first. 33, it doesn't matter. It has to break above 34 before you see some sort of a change there in the DAX. So that's the most negative chart. I think if the Nifty is the most positive, that's the most negative. Let's go ahead and take a look at gold. I know you're going to ask me about it, so let's just go ahead and talk about it before we bring it out. And the last time we were up here, which was just what, a week ago, I said that I really thought couldn't imagine gold not testing 174. It's just hard for me to imagine with what was going on and interest rates, inflation, etc., that gold doesn't test the 174 level. Well, it fell back down. Well, now here we are again. So we're right back up there with a big update in gold today. So, I mean, I still stay with the same thought process. It's hard for me to imagine that we aren't going to go test that resistance at 174 there on gold, on the GLD. So we'll see how that plays out. But if we can get another update like we had today, I think that seals the deal. It'd be hard to imagine it going up again, breaking above 171, and then from that standpoint, not hitting 174. But, you know, I felt the same way back on December 31st, and then we fell back to the downside. So we'll see how that plays out. But that's been my position. If you've heard any of the recordings I've done, you know that I've been saying that. Hard for me to imagine gold not testing 174. I looked foolish a week ago, but now it's like, here we are, right back to that level again. And I think that's a very high likelihood of occurring. All right, so normally at this point in the presentation, I would show you a closed alert, and we've had some really good ones. I'll save it for next week, where we show you MTB, which went from a 90% loss to a 94% gain. I want to go through and show you that, but we'll save that for next week because we have that big presentation tomorrow. I wanted to go ahead and show you this listing. Let me make sure that you're seeing the right screen here of our time strategies, which is what we're going to talk about in that special presentation tomorrow. And you can see that almost a 25% gain on QDEL. We're at a 10% loss in ALLK, but man, all we need is a little bit of a move back to the upside, and that becomes gold. But 21 days is kind of the time frame. So if we get to 21 days and we have a small loss there between the two, that's a 15% gain between those two. Everything else has been close. Look at these returns on the time strategy, and you can see why we're so excited. 42% gain there. And prior to that, an 82% gain, 81% gain, 117% gain, 47% gain, 63, 81. All of those gains are in the 21-day or less time frame. And this one was a negative one, and that one was 35 days. So that was longer than normal. There's 20 days, 116%, 21 days, 100%. So you can see why we're so excited about this. Now, this is AI based. And the way it works out, I'll just give you a quick preview. Gave some certain criteria to some AI guys. They took it and ran with it and created this system. I showed you what was on the CNBC mobile app as far as where AI is going in 2022. And we actually have a subscriber that says he's been working with AI for the past 20 years. And he was really curious as about what we could expect to see from AI moving forward. It's really interesting. So we are super excited about it. And with the fact that it's a conversation on CNBC, which means it's conversation in the financial trading arena, not just science, pure science, we feel like we're kind of on the cutting edge. And that's a very exciting thing. All right, so if we take a look at some of our past case study considerations, we can look at IRM and check this out. This is kind of exactly what is supposed to happen with these triangles. So here we are, and we have this resistance level here, and then we have a set of higher lows. So an ascending triangle, and you could have made a case for drawing the low all the way back down here if you wanted to. And check out the breakout. Look at that. So we start to the upside and then massively to the downside. So it's easy to say, oh, take off the calls up there and hold the puts. That's a pretty difficult thing to manage intra trade, if you will. But the bottom line is we started at 50. We didn't quite get a 10% move to the upside. Now we're almost at a 10% move to the downside. So what looked like an upside breakout may actually be a downside profit. What I wanted to share with you here is this is a perfect example of why you don't take the opposite leg off too soon. It would have been pretty easy as we were breaking to the upside to say, oh man, we're breaking higher, let's take the put off. Well, we didn't get to the point quite yet where we were looking for our profit, almost, but not quite. And so had you taken the put off, you'd be like, oh man, there goes that gain that we had. Now we're at a loss. Now, well, the fact that you still have the put, now you're almost at the profit that you were looking for on the put side, when just a week ago, there was a profit on the call side. So it's a perfect example of why be really, really prudent before taking one of the legs off of a triangle. And if you want to be super conservative and very prudent on it, you know, if you get to the point where you're at a break even and you want to take one leg off, go ahead. That means the worst thing can ever happen to you is you finish break even. That's okay, or a little bit of a gain. But just because the stock starts to break one direction, don't be so quick to take the other leg off, because this is what the market will do to you, and it'll turn around and come back. All right, so let's take a look at what we looked at last week for our case study considerations, and that's amazing, right? Because we just pretty much wiped everything else off the mat here. And last week we were looking at CMZ. Pardon me. Goodness. Oh, it's the heat. I can tell I've been talking so fast the heat dries my throat out. I apologize. No, that's extremely irritating on the other end. So last week we looked at CMC and thought that might be a good case study as far as a directional trade. I still like the sector as far as where we are. The DMI still looks very strong. We have pulled back a little bit. We got just a tiny bit overbought. So back to the fourth here. So we came back down. So now we've had 1, 2, 3, 4 days in a row dead on that 10-day moving average. And look where we are. We are right at that previous wave 5. So look, we're finding a bit of a push and pull, if you will, a fight between the bulls and the bears right at that major point of support resistance there at 36. So if we can break back above that, I think we're good to go. I don't see any reason why you would abandon this trade at this point in time. I think it's just we didn't want to get too far away from it without testing it, but the DMI still looks very good. So I think that looks good. And then we also looked last week, and I wrote this one down. So let's see what happened here with Monster Beverage, considering the fact that we've had some pretty significant moves lower in the market. And it's held in there pretty well, honestly. I mean, we did move to the downside, but look, we're right back to the 10-day moving average like we are with the market. And you had the Elliott wave on, and we're at a corrective pattern because the 5-wave pattern doesn't label. So we're here at resistance right around 100. We came back, tested the 50-day moving average, bounced back up. I don't see any reason to get out of that one yet either. So the two that we identified last week have weathered the storm pretty well of the market drop since last week. But I don't think that you would want to close either one of them out as far as abandoning them. Stay with them and see what happens over the next few trading days. Perhaps it was just a test of the 50-day moving average. So let's go ahead and take a look at any potential new case study considerations for this week. And if you're not familiar with the software, this is called Profit Source. You can find more information about it at hub.com, HUBB.com. To me, it's the best Elliott Wave software that exists out there. So for those of you that are live streaming with us or haven't seen much of our stuff before, we're big Elliott Wave fans, and I've tried every Elliott Wave software that I know exists. There may be some that I'm not aware of, but I've tried every one that I know exists out there in the marketplace, and I think this is the best one. You can come over here and look at these Elliott Wave options things here. One of the great things about it is you can create your own testing system, and you can put in different criteria. You can back test, you can create a set of indicators, pick your indicators. Perhaps you have your own favorite indicators that may differ from ours, and you can use it to try all of these different things. But if you're an Elliott Wave options alert subscriber and you have the software, the folks added this in here of all these tabs that you can go through and look and follow along with the searches. All these ones that say EWO, those are my search parameters. And so with them being pre-computed, it means as soon as you click there, the results are already there. You can still create your own technical trading system and let it run. It would take 10, 15 minutes to run a system on a reasonable amount of time, but these are instantaneous. So that's the difference. So let's look, there is one impulse trade. So let's see what that is. Western Alliance. So if we take a look at that chart, it'll show you that it doesn't look too bad. Let's see what the DMI looks like on here. Take these other things off. The ADX is moving up, about to break above 25. Here we go, like with the market, that we have the positive directional indicator moving lower, which is not the most ideal scenario, but we are at resistance, and we kind of tested that a little bit here at 125. I would think this is more of one of those, if you wanted to be aggressive, you could go ahead and put this on now. If you want to be a bit more conservative, you would wait until we broke above 125. You can see the low of the past 2 days at the 10-day moving average, so we're not overbought. In actuality, we're kind of trending up with that 10-day moving average. So break above 125 and you're good, and you take it from there. But more conservative approach is let it get above it with a follow through day. So let's see what else we can find here and see if maybe we can find something else that might not be quite so it's not risky. But Union Pacific is in our corrective set, so that could be a stock that's coming down to test the 10-day moving average, going through a corrective phase, perhaps a zigzag, or maybe an end of a wave 5 and coming back down to the previous 4. All those are possibilities there. You can see we have broken below the 10-day moving average, and I was looking at Western Southern earlier today, and I think that one is kind of a bit of a mess of a chart as well. So it may just be that the railroads, for whatever reason, are starting to break down a bit. That's a little confusing with the fact that oil prices are going up. You would think that with oil prices going up, the railroads would be doing well. People be maybe looking to ship freight a different way. So that's one of those things that it's a correlation that usually exists, and when it doesn't and they get out of whack, they don't stay out of whack for very long. So I think something's going to happen there between the railroads and oil. Either oil is going to back off, and that allows railroads to stay moving to the downside, or vice versa. But this doesn't make much sense to me from a fundamental correlation standpoint. So potentially moving back down towards that 50-day moving average on Union Pacific. Let's see what else we can find. Maybe we can find something that's in a bit of a triangle. 59 consolidating stocks. You can come here and add that wave 3 on there. So what we just did was we took 59 charts that are consolidating and took them down to what, 5 there. So Morgan Stanley, take a look at that. Vanguard Midcap. I kind of like the idea of Morgan Stanley because of the financials. We actually sent out an alert on the XLF to our alert subscribers today. The problem is here, the ADX has got to get above that negative directional indicator and above 20. So it's not quite there yet. Other than that, that would look really good. And isn't it interesting that we're at a major point of resistance here too on Morgan Stanley? So if we could break above that resistance area and we have a supportive DMI, we could be really off and running on Morgan Stanley, but can't really say this is a case study consideration for the week when the DMI doesn't confirm. So we have to stay with our indicators. So let's try to see if we can find something else. But man, that would certainly be on a watch list. I showed you the XLF earlier. See what Becton Dickerson looks like here. Dickinson, right at. I see here's a very similar story, isn't it? It's almost identical. So we've got a couple really good watch lists here. Look at the ADX trying to move to the upside. And when you see that, you're like, oh, it's going to do it. Just give it another day or two. It'll break that. So let's go ahead and put the trade on. And it does look like the ADX is going to break above the negative directional indicator and break above 20, and that we're going to be off to the races to the upside. And that all may very well happen. But I've also seen plenty of times when the DMI looked exactly like that and the ADX got up near 20 and just rolled over. It's got to break above 20 and it's got to be broken above the negative directional indicator with good separation between the two directional indicators. Those are the rules for the DMI. So it's got to be there. So we can't look at that one as a case study consideration for the week yet either. So let's see if we can find something else. KRA. Don't know what's going on there. They got bought out, obviously. When the stock goes like that, dead sideways, that's a buyout, merger, acquisition, something along those lines. Let's look at the mid caps. I haven't heard a whole lot of chatter about the mid caps, but VOE here, and we are holding above a break of previous resistance right there at 152. So we've broken above it and we are trying to hold there, but look at the ADX. Again, the ADX not really interested in the move at all. In fact, on an up day with the mid caps, it ticked down on the ADX. That's not something that we can support as far as a potential upside trade. So let's see what else. AEE, let's try that one. Yeah, that's not what we're looking for either. So challenging trying to find a case study consideration for this week. So let's take all that stuff off and then let's just look at the consolidating stocks list and see if we can find something that we like and go from there without any gold. Interesting that it's on the list again. Goldman Sachs. See what that looks like. Well, that's really about as good of a triangle as you could expect right there. Well, that's not going to work for us, though, because it's a $400 stock, but a really nice symmetrical triangle. You've got the ADX diving down. Oh, look how low the ADX is at 11 and moving lower. That's a great looking triangle. So that all looks good. Let's just take a look at the XLF and see what that looks like. We did well on that one before as a case study consideration. So that's in the financials. And you can see that we broken higher and we're above the 10-day moving average kind of nicely, almost maybe a tiny bit overbought. We have resistance there at 41. So perhaps we come back down. Will be support now. Was resistance at 41. Only concern there would be that gap down there about 40. But we talked about this earlier with the supportive DMI. I think that is as good as anything. So let's go ahead and make a note of that for today. that the XLF is our case study consideration for the day. With that, I'll go ahead and open it up to a few questions. Ran a little bit longer than normal here, but that's normal for me. George is asking for KIM. So we'll take a look at KIM is right there at 25. I'm not a huge fan of these REITs because typically they don't move a lot, which is challenging with options unless you're short options, and we don't do that at Elliott Wave Options because it's too much risk to be purely short. Now we'll sell options against a long option because that limits your risk, and in some cases limits it even more. But we don't just sell naked options. We don't do that. So sitting here, looking at this support level at 25, I think the easy thing is here is it looks like a wave 3 that looks fairly strong. Let's see about the DMI, and the ADX looks great. The only thing is that that positive directional indicator needs to turn and move back to the upside. It didn't with today's move, but you've got your stop there at 25, right? If it breaks below it, closes below it, and then trades below that low again, then you go ahead and take that off. But if you want to take a shot to the upside, go ahead. The thing that would bother me about a REIT right now is that I don't see interest rates going down anything significantly for a while. In fact, I think they're going up. So I think the real estate market is going to struggle, even if the economy can handle increased interest rates, which there's a ton of commentary on the financial networks today about that. But even if the market can handle that and the economy can handle it, I don't know if real estate can. Maybe. So you follow the charts, but that's a tough one for me right there, George, at 25. But if you want to be long, that's your stop at 25. Timothy wants to ask about Amazon. So let's take a look at Amazon. And somebody asked me last week if I thought Amazon could come down to 32, and I said yes. And look what we did. Go pull up the recording from last week. That question was asked. Do you think Amazon could hit 32? Yep, 3,200. I said, yeah, I thought so. And so we closed back above it. So it traded below it, but closed above it. And then here we are, right back to the 10-day moving average. So where does Amazon go from here? It's trading right at the 10-day moving average, so it's dead on with the SPY. I think that there's a lot of support resistance here through this area now with Amazon. So 3,400, I couldn't really see being long Amazon until it got back above 3,400, and that's back above the 50-day moving average as well. So back above 3,400 with a follow-through day, then I think you can go long Amazon. But I was asked, do you think it could hit 32? Hopefully you got that trade in. Pawncash wants Twitter. Man, all these tech stocks have been beaten up, but trying to come back. And there's a bit of support that it's created at 40. Got to get back above that 10-day moving average. And the issue there is if it does, it still has resistance at 45. So the deal with Twitter is if it can get back above the 10-day moving average with a follow-through day, can it get above 45? Because excuse me, that break above 40 is meaningless. And even the break above 45 is meaningless. Or excuse me, the break to 45. It's got to get above it. A break above, just to make sure I'm clear here, the break above 45 would be meaningful. So breaking above the 10-day moving average is what I was trying to say doesn't mean anything. You got to get back above 45. So if you break below 40, I think you go short. In between 40 and 45, I think you wait. If it breaks above 45, then you can go long again. That's the way I see that. Vince, we'll talk about all that. The answer is yes on the AI. We'll talk about that Thursday night. Kev on the XLF. We'll talk about that Thursday night as well. Mike's asking if the market reacts negatively to interest rates, won't rates also correct due to money flow flooding back into bonds? Well, that's the big question, Mike. Is money going to flow back into bonds? You might be right. But if the Federal Reserve is not in there buying, and that creates a lower demand, and that in turn brings prices down and rates up, is somebody else or other countries going to step in and buy and take advantage of the higher rates? I mean, there's an argument there because most of the rest of the world is at negative rates. And if we're having rates go to the upside, you could say that, hey, maybe they do. I think that's the unknown, though. I mean, the Federal Reserve has been buying so many of our bonds. Well, they're not actually, but, you know, notations on their balance sheet, but you get the idea. Are other countries going to soak up that missing demand? I just don't know. If so, then yeah, that changes the scenario. I tend to think that maybe there's not the demand out there, that even if our rates go up, other countries are kind of pretty extended already, and they don't see them filling the void of what the Federal Reserve has been doing, which is why I see rates continuing to go to the upside. Maybe not as vertically as they have been. I think we get a consolidation of rates first, and then they start to creep higher. That's what I think happens. And then the common thread is that the Federal Reserve always overshoots the mark. So they overshot the mark on the liquidity side, in my opinion, and then they'll overshoot it on the tightening side, in my opinion. So I think rates go to the upside, but I think the question you pose is the great unknown. Is there demand out there in the rest of the world to take up for what the Federal Reserve is no longer purchasing? I have an answer to that question. It's a really good one, though. Irene is asking about Pfizer. Let's take a look at Pfizer. Well, Irene, that's a really good looking triangle. Where's the ADX here? Look at that wave 4 right at the 38.2% level. That's fantastic. Well, there's the issue. That's why it's not on the search yet, right? The ADX is a little too high. That one becomes an interesting conversation because we like the low ADX, and we have AI that's working on finding these triangles that break out a bit sooner. But look at that. You've got a doji there right at the exact point of that triangle. It may not wait on the ADX to dive down to 15. Where is it now? It's at 25. So with that nice of a triangle, it may break immediately. And I do want to be clear that you don't have to have an ADX at 15 or below for a triangle to break out. There's plenty of triangles that break out when the ADX is above 15. The issue becomes sometimes triangles form and then they give you a false breakout to the upside, false breakout to the downside, which we know never happens. So that means it's forming a larger triangle, and that's the ADX continuing to go to the downside. So then you have the erosion of time decay on both the call and the put, and that becomes frustrating on waiting for the move. So that's why we prefer to say, let's just start on them when we already have the ADX lower, where there's less likelihood of that larger triangle occurring. They still happen, but there's a less of a likelihood. But with that triangle and a doji there, that could be one of those that breaks immediately anytime. But that's a great looking pattern. So thanks for bringing that one up. VNOM. Viper Energy. I guess that's supposed to be Venom for Viper. So you know, the XLE, let's look at the XLE. That looks pretty good moving to the upside, by the way. It's hard to imagine it not hitting that wave 5 target. Yeah, look at that DMI. That's a good one. I like that one a lot. That could be a case study consideration for the week there. Why? Because look at the break above the previous wave 3 high right here. So we broke above that high. And then we have the ADX breaking above 20 between the two directional indicators. That's gold. And ADX, or excuse me, the CCI has come down a little bit, but it's in the upper threshold, and you got a nice CMF. That looks good. It's the CCI that was keeping it from showing up. But yeah, I like that one a lot. In fact, well, putting that in parentheses as far as very close to being one of our impulse search candidates. I think there's a great chance that goes to 28. So I did want to look at the XLA as far as energy, and then I'll go ahead and get a couple more questions before we wrap things up. And for those of you that are joining us in the streaming services, we get to as many questions as we can, but if we miss you, please sign in again next week, and we get to as many as we can. So the SLE, look at that, hit that 5 dead smack on today, right there at a 90% extension, and it's gone a bit vertical. So maybe energy needs to rest a little bit here. I know oil was up big. We have a big break here, and it just took off, didn't it? Once we broke above 59. And so we ran up there. Perhaps energy needs to calm down a little bit, but I mean, that still looks good. That other chart of on Venom, look, and we haven't even, we're just now triggering on the DMI. I think energy has a long way to go. We're looking at that as another alert for our alert subscribers too, by the way. Just looked a little bit overbought today is the only reason that one didn't go out. You can see there's some separation with the 10-day moving average. So kind of wanted to see if maybe that one would consolidate just a little bit. GPN. See what that one looks like. Global payments. Does it have legs was the question. Well, the issue here is it's got to get above 160. If it gets above 160, then yeah, I think it has some serious legs. It's above the 10-day moving average. It has been for a week. It's handled that move down in the markets awfully well. The DMI could be better if the positive directional indicator was a little higher. The ADX is fine. But with the move you've already had from 120 to 150, for me personally, I'd want to see that break above 160. If it does, then, man, that could be off to the races. But there's a lot of resistance there at 160, so it's got to get above that first, in my opinion. Our blocks. Looks like KMI is one that was being asked before, and they had written KIM, but meant KMI. So it had to hold 80. So far it has. I think we talked about this one before, that it was likely to go down there and fill that gap. When we looked, maybe last week, was it last week or 2 weeks ago, we looked at this, and it did. It went down to 80, just like we talked about. It felt like that was where it was going to go, and it needed to hold there, and it has. But see, that wave 4 with a 93% correction means that that wave 5 pattern has been disqualified. You have to take that off. So now you're just looking for a bounce off of massive support. And there is a ton of support there at 80. So if you want to be really super aggressive, then you could take a look at that one and say, hey, you know, let's see if we can catch something to the upside from here. But the easy stop is that if you break 80, you get out. So from a risk to reward standpoint, it's not too bad. You break 80, you're out. KMI, Kinder Morgan, I think is what some people were looking at. And the wave 4 here and a 5 pattern is tracking to the upside pretty well. That may be a disqualified pattern because that DMI makes it look like we're not done yet. And we have some resistance above. The DMI is leading you to believe that we're going to break through that. And it's pretty significant there at 18.5. But you got a pretty clear path up till 18.5. And then, you know what hits the fan, and we'll see if it can get above that 1850. If it does, then man, that one could be off to the races too, but that's a lot of resistance there. at 1850. Chandu wants to look at Boeing, BA. Man, would hate to have anything to do with airplanes right now with everything they keep getting hit with. But there's no wave 5 impulse pattern, so we're in a corrective pattern. The ADX is low. I can't really call this one a triangle, even though we have a really nice set of higher lows, but the lower highs, it's a pretty good angle there, but they need more touches than the line, like we have here on the lower trend line with the higher lows. So the fact that we don't have that, that's concerning to me. But we got above support at 210. So there's a major point of support resistance at 210. It was able to break above it. Can it break above it with a follow through day tomorrow? If so, then maybe Boeing is ready to run up. There's some resistance there at 230 and some more at 240. So it's got some stuff ahead of it. But if you want to be really aggressive, you could take a bullish shot at it with a 230 target, because that again may pose some resistance. And if that doesn't, 240 is. So you can see right in that area, it's got a lot of work to do, but perhaps it gets a free run up till that level there. Looking at the SPY, we did that earlier, but we'll go ahead and finish up with looking at the SPY for tomorrow. But that's how we started things off with the SPY. And, it's just, the key is the 470 level. If you missed it earlier, if joined us late, it depends on whether or not we can break above and close above 470 with the follow through or confirmation day. That's going to be the key. So we normally keep these to an hour, but we ran extra long. Again, if you missed the very beginning, please sign up for TradeFinder if you're just viewing it from one of the streaming services, because we have a special presentation for you tomorrow on our new AI-based time strategy. So I think it's the cutting edge of where technical analysis is going to go. Really excited for you to see it. And it's something for you guys tomorrow night. So please make sure to take advantage of it. Look forward to seeing you then. Otherwise, have a great week.